Hello, my name is Sam Campagna, and next year I'll be going to Cal.
Hi, my name is Christoph Corbell, and I'll be going to University of Texas Austin next year.
Hi, my name is Justin Dominic, and next year I will be attending Yale University.
Hello, my name is Aiden Donahue, and next year I will be attending the University of Notre Dame.
Hello, my name is Elvin Lee. Next year I'll be attending Lehigh University.
Hello, my name is Ben Newbern, and next year I'll be attending Northwestern University.
Hello, my name is Jesse Troyer, and next year I'll be attending Harvard University. Welcome to our capital markets presentation.
Recently, President Biden has introduced the American Jobs Plan to help Americans suffering through the pandemic. We mostly agree with the $100 billion investment in digital infrastructure that provides broadband access for rural communities and Americans across the country. The pandemic has highlighted the necessity for internet access for all Americans, including the workforce, education system, and the economy at large. We also agree with the $137 billion investment in early education, K through 12, and community colleges. We think generally any investment in human capital is a good idea, and we also think it will help repair the massive job loss due to the pandemic by adding a more educated workforce.
While all of the spending was on things that you may consider useful, some of the government spending in the infrastructure bill we consider to be unnecessary at this time. Especially with COVID, there's been a lot of spending as of late, so we believe that spending should be focused on more immediate needs and only the most important long-term projects. So things like the money spent on building and retrofitting homes and commercial buildings, on highways and transportation systems, we believe were unnecessary at this time and would be better served coming in a later bill.
The coronavirus pandemic took an immense toll on the United States economy, and it was the job of federal organizations to lessen the severity of the economic damage. The Federal Reserve did what it could to mitigate this recession. As of March 30th, 2021, among many other policies, the Fed cut its target for the federal funds rate by a total of 1.5 percentage points. The Fed bought Treasury securities in the amounts needed to support smooth market functioning and effective transmission of monetary policy to broader financial conditions. Through the primary dealer credit facility, the Fed lowered interest rates for primary dealers. The money market mutual fund liquidity facility was also relaunched by the Fed. The Fed announced that it would backstop up to $750 billion of corporate debt. With the second market corporate credit facility, the Fed purchased existing corporate bonds, allowing companies to credit so that they could maintain business operations. Almost all of these lead to an increase in the money supply and thus increases in inflation. What should the Fed do for the future? Last year, the Fed moved to a new inflation policy where it would tolerate a range for inflation on both sides of its target of 2%. The Fed will have to defend its zero interest rate policy and its bond purchasing program as a whole wave of data shows a big jump in economic activity and inflation, which could rise well above 2%. The Fed should voice a continued implementation of the near zero interest rates with an end at a specified level of economic stability. Allow banks and corporations to continue to operate at these levels, but give a clear deadline so that they can wane off dependency on low rates of interest. Peter Bookvar, chief investment strategist at Bleakley Advisor Group, stated that they're still looking at 2024 as their first hike. The amount that the Fed continues to flood the money supply with coronavirus monetary policy cannot be sustained into the future.
Let's look at the major indicators. According to Federal Reserve economic data, the economy has been steadily recovered from the pandemic-induced recession. After falling sharply from $19.25 to $17.3 trillion in the second quarter of 2020, real GDP has been on a steady climb in each of the last 3 quarters, with our most recent one being at nearly $19.1 trillion. We should continue to see a steady climb in the coming quarters, as was the pre-COVID norm. The official unemployment rate, the U3 rate, has seen monthly improvement since peaking at an alarming 14.8% in April 2020, now sits at 6.1%. However, the unemployment rate's rate of decline has slowed in recent months. The rate even jumped 0.1% from March 2021 to April 2021. This pace makes returning to the pre-COVID 3.5% unemployment rate a dozen or more months away at best. The government should look towards innovative preventionary measures to reduce unemployment both now and in the future, as opposed to simply targeting a recovery from COVID job loss, as there are looming future concerns like the increasing automation of the labor sector, which will pose additional threats to the official and natural unemployment rates down the line. As earlier mentioned, the Fed's record low federal funds rate has resulted in a large increase in the US M1 money supply, which reflects a concerted effort on the Fed's part to pursue expansionary monetary policy. For instance, the Fed lowered the rate at which it charges banks for loans through the discount window from 2.25% to 0.25%. This inflow of liquid funds allows for banks to keep functioning. It is worth noting that the money supplies remained largely unchanged for numerous years before the pandemic. While the increase in the money supply has been largely necessary move by the Fed to increase consumer spending by lowering interest rates, as Ben noted earlier, it is likely unsustainable at its current rate, though the Fed is reportedly considering not hiking the federal funds rate until 2024.
Personal consumption in the US dropped from 13.1 billion to 11.8 billion in quarter 2 2020, and now in quarter 1 2021, consumption is at its highest. Barring any negative changes to COVID-19, we should assume that the consumption continues to rise as it has been. Private domestic investment went down by 500 billion in quarter 2 2020, and now in quarter 1 2021, gross investment is at 3.5 trillion. It is not the highest compared to quarter 4 2020, but it is generally trending upwards. Finally, government total expenditures spiked in a gain of $3.5 trillion in quarter 2 2020, and while it lowered to more normal numbers in quarter 4 2020, it has gone back up to 11 trillion in quarter 1 2021. These spikes are sudden outliers to the normal trend of a steady increase of government spending per year.
The pandemic devastated American jobs. Unemployment began at 3.5% in February of 2020, but spiked at 14.8% in April of that year. At the spike, the unemployment rate increased by 300% from the previous year. However, since that spike in April, the unemployment rate has seen a consistent decrease, leveling out to around 6% last month. Moving forward, analysts should continue looking at the unemployment rate relative to the natural unemployment rate to determine the level of cyclical unemployment caused by the pandemic. As the unemployment rate approaches the natural rate, the US economy can near full production. While heavy government spending can raise the GDP, an overly large deficit can also be dangerous. Too much government spending crowds out investments, and larger deficits outweigh productivity boosts from those new public investments. Therefore, we believe that Congress should allocate most of their spending towards human capital and the environment. Investing in education not only serves to increase worker productivity, but it is also preventative against future job losses, like Jesse mentioned earlier. Highly skilled workers can find work more easily, and with automation's possible elimination of manual labor jobs in the future, investing in education could ease that transition.
Since the inception of our stock trading experiment on February 23, 2021, where the S&P 500 was at 3,881, the S&P 500 steadily climbed to a current day level of 4,188, as a measure of the stocks of the top 500 corporations inside the New York Stock Exchange. Similarly, the Dow Jones Industrial Average improved roughly 2,300 points as of May 11th, and while the NASDAQ dipped by roughly 360 points in that span, that short decline pales in comparison to that indice's strong upward trend from the second quarter of 2020. These improvements in the financial indices reflect the strong resurgence of large corporations and small businesses, with vaccine rollout, less restrictions, bailouts, and stimulus checks. Analysts should keep an eye out for changes in the COVID-19 protocols that may increase or decrease the rate at which businesses and the economy as a whole are going up.
Though these indicators are able to tell us a lot about the state of the economy and the money flow, and they give good information to base recommendations on, they can't tell the whole story. GDP and many of the other indicators fail to take into account factors such as population health and education, environmental stability, and general well-being. We believe that there should be a focus on spending money on increasing long-term quality of life. So things like education and the environment should take a higher precedence. COVID is quickly becoming a less pressing issue in the United States, so preparing for the future is important. While most financial indices do not display this information, there are indicators that analysts can watch for that focus more on the quality of life of a population. Some of the indicators that can be tracked that may aid in explaining and taking into account these values are things like the value of a clean energy infrastructure, education rates, life expectancy, and the carbon footprints of large businesses and government affiliates. So while we recommend making fiscal and monetary decisions primarily based on economic effect, we do believe that these factors should also be considered. Thank you.